Welcome back to the Multifamily Deep Dive by Bridgewater Realty Advisors, the multifamily experts in South Louisiana, Mississippi, and Alabama. So if you're an investor or a developer or, even just someone starting to poke around in that 5+ unit space, you know that financing can feel like, well, like the dark art of the industry.
It really can. It's opaque. It's filled with jargon.
Exactly. And it seems to change every single time you get a new term sheet. So today, we are taking what is probably the most crucial and, the most complicated topic in real estate financing, and we were just peeling back every single layer. And this isn't about, general national mortgage rates you hear on the news. This is a real practical deep dive into the mechanics of multifamily financing and underwriting, specifically here in Louisiana and the wider Gulf South.
Right.
We've gathered the sources, we've done the synthesis, and now we're ready to guide you through that maze. We're going to focus on what truly, truly matters in this unique market.
And that focus is really our whole mission today. Because financing, it's the hinge that every single deal turns on. I mean, you can find a property with just phenomenal potential, but if the financing structure is flawed,
it's dead.
It's dead. Or, and this is the critical part for our region, if the underwriting doesn't match the local realities of risk, the deal just completely collapses.
Right.
So our goal is to clarify that whole process. We're going to unpack the three critical pillars of lending and then reveal those unique local factors. We call it the Louisiana twist. It's what makes deals in South Louisiana, Mississippi, and Alabama so distinct.
I love that. The Louisiana twist.
Exactly. By the end of this, you should be able to look right past all that generic national advice, avoid the information overload, and just focus laser-like on the key financial drivers of whether a deal is going to succeed or fail right here.
That practical application is so important. I think we all need to stop thinking about financing as some kind of mystery and start treating it more like, applied science.
It is. It's math.
It's math. So let's start with the absolute physics of lending. Because while the math, like you said, might be universal, the inputs are absolutely local.
That's the perfect way to put it.
Okay, so let's unpack this. When most people talk about getting a loan, they immediately, they zero in on the interest rate, maybe the amortization.
Sure, the headline numbers.
But the rate is just the output of a much more complicated and, frankly, high-stakes negotiation. Like a three-way negotiation that has to satisfy everyone involved. So what are those three core forces that have to align perfectly for a deal to come together?
It's a beautifully balanced system, really. It requires consensus among three totally distinct forces. First, this is the big one, you have the property cash flow.
Okay.
This is just the property's raw ability to generate enough net operating income, the NOI, to safely service its debt. I mean, can the asset cover its monthly payment with a comfortable margin? That's question number one.
The most important question.
The most important. Second, you have collateral risk. This is the lender's worst-case scenario question. If everything goes wrong, if the property fails and the loan defaults, can we, the lender, be made whole by foreclosing and selling the asset?
What's our downside protection?
Exactly. What is the downside protection? And then third, and this is the one people often forget, is the capital source itself.
Meaning the lender.
The specific type of lender. Is it a regional bank? Is it an agency like Fannie Mae? Is it HUD? Is it a CMBS conduit? Each of these sources has its own regulatory structure, its own set of non-negotiable rules, and really defined risk appetites. They all play by a different playbook.
So all three have to give a thumbs up at the same time. And if, say, just one of those pillars is even a little shaky, like the property's cash flow margin is too thin,
the whole thing wobbles.
The whole structure wobbles, and the lender either says no or, comes back with much tougher terms.
Right. They'll ask for more equity, a higher rate, something to compensate for that wobble.
Okay, so the sources make this really fascinating distinction. They say Louisiana doesn't change the physics of lending. A 1.25 DSCR is still a 25% cash flow buffer anywhere you go.
Correct. The math is the math.
But it significantly alters the risk stack. What does that actually mean for an investor who's used to buying property in, say, Texas or Arizona?
It means that the fundamental rules of gravity still apply, but here we're standing on a slightly tilted and, frankly, unstable platform.
Huh?
We have localized risk factors that disproportionately and very severely affect two of those three pillars we just talked about, the property cash flow and the collateral risk.
Okay, so which factors are we talking about?
Well, because our local environment carries these amplified, highly volatile risks, and let's be honest, they're mostly climate-driven here. It completely changes the game. It influences which types of national lenders will even participate, how conservative they have to be in their projections, and at the end of the day, what loan terms they can offer.
So the game is the same, but the difficulty level is turned way up.
Demonstrably higher, yeah. It's because of the specific geographical variables that you just do not have to deal with in the Mountain West or the Northeast. It's a whole different ballgame.
And according to our material, the number one variable, the one that causes lenders to just obsess over the balance sheet in the Gulf South, is this deep dive into insurance and catastrophe risk. So why isn't this just another line item? Why is it the critical factor?
It's the sheer volatility. The volatility combined with the immediate, and I mean brutal, impact it has on the property's financial stability. Lenders are obsessed with wind and hurricane exposure, with flood potential, and this is the key, with the policy renewal volatility.
The renewal, so not what you pay today, but what you might pay tomorrow.
Exactly. Because that insurance volatility, it directly and very rapidly blows up the net operating income, the NOI, and as a result, the debt service coverage ratio, the DSCR. It's a risk that is rapid onset, it's recurring, and it's almost entirely external. You can't control it.
Okay, that's the mechanism I really want to clarify for everyone listening.
Yeah.
Because you see an expense jump and you think, okay, less profit for me. But you don't always internalize that cascading effect it has on your borrowing power, on the very value of your building. Can you walk us through that?
Sure. Think of it this way. The value of a 5+ unit property is, generally determined by taking your NOI and dividing it by the market cap rate.
Simple enough.
And your loan size is then dictated by that NOI through the DSCR calculation. So if your annual debt service, your mortgage payment is fixed, but your largest single operating expense, the insurance, suddenly doubles or triples when it renews.
Which it can.
Which we've seen happen repeatedly. Your NOI is instantly slashed by that massive difference. And if you have less NOI supporting the same amount of debt, your DSCR just plummets. It falls right below the lender's minimum required ratio, which is often 1.25x.
And when that DSCR falls?
The debt is automatically viewed as unsafe. The lender gets nervous, and the property's value, at least for lending purposes, falls right along with it.
And this isn't just a theory, right? We've got data. I mean, we've seen documented evidence from major industry groups like the National Multifamily Housing Council citing these sharp increases in insurance premiums as a major sustained operating cost pressure.
All across the country.
All across the country. But for us, that pressure isn't just, a 10% increase. It could be a 100% or 200% spike in 1 year.
That is the reality on the ground here. And, the sources point out that even the regulators are getting concerned. The Louisiana Department of Insurance has publicly discussed this market stress, this ongoing underwriting sensitivity in commercial lines.
So the state itself is acknowledging the problem.
Absolutely. And that confirmation from state bodies, it signals to lenders that the sensitivity they're showing isn't arbitrary. It's a necessary response to a systemic market dislocation, where insurers are either pulling back their exposure or demanding dramatically higher premiums to cover their own immense risk.
So when that happens, the lender has no choice. They have to use a much higher, more conservative, normalized insurance cost when they're underwriting a potential loan.
They have to. They have to price in that future risk.
Okay, so let's make this real. How does this catastrophic risk actually manifest itself in the loan terms that you're going to see on a term sheet? Give us the practical consequences.
This is where the paper projection meets a very painful reality. First, and most obviously, you see lower loan proceeds.
Less money.
A lot less money. If the lender assumes the normalized insurance expense should be double what the seller is currently paying, which is a common assumption, they immediately apply a massive haircut to the seller's advertised NOI.
So less underwritten NOI means they can lend you significantly less money.
Right. The deal immediately becomes DSCR limited. That means the property's cash flow capacity, not its market value, is what determines the final loan size.
Okay, what's number two?
Second, you see bigger escrows and reserves required. A lender is going to anticipate future spikes, so they might require monthly escrows for taxes and insurance that are far higher than the current bill. Sometimes they even set aside extra capital just to cover the expected cost of the next renewal.
Wow. So they're planning a year ahead for that pain.
They have to. Third, you get way more conditions during diligence. You'll need comprehensive proof of insurability, not just a quote, a binding commitment from a specific A-rated carrier. They will mandate named storm reserves, where you pre-fund a separate escrow account just for hurricane risks.
And the deductibles. I hear the deductibles are a huge issue.
They're a massive issue because when deductibles are now so large, often 3% or 5% of the total replacement cost lenders require you to prove you have that entire deductible amount sitting in cash, either liquid or held in a restricted reserve.
Wait, so if the deductible on a $20 million property is 5%, that's $1 million.
$1 million.
You have to have $1 million just sitting there locked up in addition to your down payment.
Precisely, which completely changes the capital requirement for the borrower. And that leads to the fourth and honestly the most devastating consequence: the high likelihood of deal fallout.
The deal just dies.
It just dies. A buyer and a seller agree on a price based on a pro forma that, maybe conservatively estimated $65,000 a year for insurance. The lender's broker does their due diligence, gets a firm quote back, and it's $175,000.
Wow.
That $110,000 difference per year just vaporizes the cash flow buffer. The lender comes back and says, look, based on this real expense, we can only lend you $2.8 million, not the $3.5 million you needed.
And the deal is dead. The price isn't supported by the cash flow. The buyer can't just find an extra $700,000, and it all falls apart.
It dies right there in due diligence.
That is just a brutal, rapid capitulation. It really confirms why tracking this fluctuating data is so critical. And it highlights the value of real local expertise. We should point out this is exactly why a firm that truly tracks these market movements, like Bridgewater Realty Advisors, is the leader in multifamily sales in this region.
Right.
Because they are on top of these critical fluctuating insurance data points for their clients. They can often prevent this kind of deal fallout before it even hits the lender's desk.
It is all about proactive intelligence. If you price a deal based on an artificial NOI that doesn't account for the realistic underwriting cost of insurance, you are setting that deal up to fail in the lender's office 6 weeks later. Knowing what the real insurance premium will be is the very first step to successful underwriting.
Okay, so moving from that catastrophic wind risk to the other big water risk we face, flood requirements. In a lot of the country, flood insurance is a rare thing, almost a boutique issue that maybe 5% of properties have to worry about.
Not here. Our sources note that flood map exposure is just simply more common and therefore more expensive in Louisiana.
It's a factor of our geology, our hydrology. We're dealing with vast, low-lying coastal plains. And that means significant portions of our populated areas, especially along the Mississippi River and the coast, they fall into what are called special flood hazard areas, or SFHAs.
And this isn't a lender's preference, right? This is a hard rule.
It is a hard, unavoidable regulatory rule. It's driven by federal policy designed to protect taxpayer funds, basically.
So what is that hard rule? When does flood insurance become absolutely non-negotiable?
The rule is ironclad. It stems from federal mandates tied to FEMA and the National Flood Insurance Program. If a building is located in an SFHA, which is basically Zone A or Zone V on the flood map, and you, the borrower, are using a federally regulated or federally related lender.
Which is almost everyone. Which is almost every commercial bank, credit union, and, crucially, agency lenders like Fannie and Freddie. Then flood insurance is required, period. FEMA is explicit that homes and businesses in high-risk areas with mortgages from government-backed lenders must have flood insurance.
And the regulatory tie-in just confirms this is universal.
Yes. The federal banking rules, you can look it up in the Code of Federal Regulations, they explicitly implement these purchase requirements for any regulated institution. You cannot legally finance the deal without the coverage if you're in one of those zones.
So the takeaway for the listener is that because this exposure is so common here, the issue just shows up more often and it's more expensive than in other markets.
Exactly. It becomes a major mandatory line item expense that can drastically raise your operating budget compared to an asset in a less exposed area.
And again, every single dollar you have to add for required insurance, whether it's wind or flood, it reduces that vital NOI. And that, in turn, shrinks the loan size that the DSCR constraint will allow. It's a compounding problem.
It is absolutely a compounding constraint. You have the high volatile wind and catastrophe premiums, plus the increased likelihood of mandatory expensive flood insurance. That dual pressure creates a significantly heightened and really unique risk profile for Louisiana multifamily that national lenders just have to account for.
Okay, let's shift gears a little bit. Let's go from physical risk to procedural friction. Our sources point out a fundamental legal difference that often catches out-of-state buyers completely by surprise. Louisiana is commonly treated as an attorney closing environment.
This is a deep historical divergence. It comes from Louisiana's civil law heritage, which is based on the Napoleonic Code, unlike the common law system in the other 49 states.
So what does that mean in practice?
Well, unlike many states where a title company can just handle the entire settlement process and issue the title insurance, in Louisiana, the closing process itself, the legal review, and often the actual title transfer. It must involve an attorney who is licensed to practice in the state.
Now, this doesn't sound like a deal killer, necessarily, but it sounds like a friction generator.
That's a great way to put it. It's not a deal killer, but it absolutely adds complexity and timeline risk, especially for buyers who operate nationally.
So what does it not change?
It doesn't change your interest rate. That's a market function.
Yeah.
But it definitely adds process, complexity, and usually slightly higher legal costs. For a local buyer, it's just, it's how business is done. You expect it.
But for an out-of-state buyer?
For an out-of-state buyer or a national lender who's used to a standardized title company process, it can slow things down. There are extra layers of due diligence, extra procedural checks that are necessary to make sure that the title transfer meets Louisiana's unique legal requirements. It just adds a few more steps to the dance.
So we've established the three key local differences: high insurance volatility, mandatory flood compliance, and this unique attorney-led closing procedure. All of this is really setting the stage for understanding the different types of lending that operate here. Which brings us to what is probably the single biggest financing dividing line in all of real estate. The line that determines which set of rules, which risk assessment, and which regulatory framework you have to play by.
The chasm.
The chasm. 1 to 4 units versus 5+ units. This is what separates consumer lending from pure commercial enterprise lending.
It is the single most important distinction an investor has to internalize. I mean it. If you confuse these rules, if you think a 5-unit apartment building is financed the same way you finance a duplex, you're going to be dramatically off in your underwriting and your expectations.
Okay, let's start on the smaller scale then. 1 to 4 units. Our sources define this as generally being treated as a dwelling or a residential structure in the federal definitions, the kind used by the Consumer Financial Protection Bureau.
And that classification makes all the difference in the world. Because it's viewed as residential, the entire underwriting framework focuses on the person.
The borrower.
The borrower. The underwriting focus is far more driven by the borrower's income and their personal financial history. Lenders are looking primarily at your debt-to-income ratio, your DTI, your W-2s, your personal tax returns.
That the property's rental income still matters, though.
No, it's important, but the lender's ultimate recourse and their primary concern is the borrower's ability to personally service that debt. Even if the building is completely vacant, they are lending to you.
And that's what leads to those really standardized loan characteristics we all know, like the 30-year fix.
Exactly. Long-term fixed rates, 30 years is common, and the entire market is supported by these standardized underwriting criteria and, the massive secondary market that Fannie and Freddie provide for conventional mortgages. The risk is standardized, it's aggregated, it's shared. That makes these loans predictable and relatively easy to get.
And the valuation is different, too.
Completely different. The valuation approach is primarily a sales comp-driven appraisal. They just look at what similar houses or duplexes in the neighborhood sold for recently to determine the value.
Okay, now let's jump across that chasm to 5+ units. Commercial multifamily underwriting. Why does adding that one extra unit, that 5th unit, flip the entire underwriting process completely upside down?
Because when you hit that 5th unit, the property ceases to be a dwelling in the eyes of the lender. It becomes a dedicated business operation.
A business.
A business. And so the focus shifts entirely from your personal financial health to the property's intrinsic profitability.
So what is the core focus of the underwriting in that case? What are they looking at?
The property must stand on its own, period. It has to stand on its own based solely on its NOI, its DSCR, and its reserves.
But the borrower's cash flow still matters a little bit, right? They want to know you're not broke.
Of course. Your global cash flow still matters. They need to know you're solvent, that you have liquidity. But it is strictly a secondary metric. The primary question is always, can the asset's generated cash flow reliably support the debt? If the asset can't, it doesn't matter if the borrower has $10 million in the bank. The deal, as it's structured, is flawed, and they will not underwrite it successfully.
And this is what triggers that lender's intensely granular scrutiny list. What specific documents and metrics are they just picking apart line by line that they wouldn't even glance at on a quadplex?
The scrutiny is forensic. I mean, they examine every single line item on the trailing 12-month financial statement, the T12. They study every single lease, looking for short-term deals or sweetheart deals for friends and family. They deeply analyze delinquency and bad debt. They will absolutely refuse to underwrite a property at 100% occupancy if the collection rate is only 85%. They scrutinize concessions, they mandate specific expense ratios, they require standardized replacement reserves for future CapEx. They don't care if the seller promises to save up for a new roof.
They want the money set aside now.
And circling all the way back to our first section, they put massive, immediate emphasis on those local risks. Crime statistics in the area, and especially those flood and wind insurance costs. Everything is viewed through this harsh, realistic lens of ongoing business risk.
Which brings us to the crucial translation. This might be the most important takeaway from this entire section for anyone listening.
Absolutely. In 5+ units, the rule is simple and it is unforgiving. You don't qualify, the deal qualifies.
Say that again.
You do not qualify. The deal itself qualifies. Your personal balance sheet is just the liquidity buffer. But the property itself must prove that it is robust enough to withstand economic cycles and, here in Louisiana, severe weather events. If the property's conservative NOI cannot support the debt service at the required DSCR minimum, you do not get the loan. You're buying a business, and the bank is analyzing that business.
That is such a clear and critical distinction. So now that we've defined the underwriting environment and the commercial rules of the road, let's look at the actual sources of capital. Where can you go to finance a 5+ unit deal in Louisiana?
Okay.
The most common names people hear outside of their local bank are the government-sponsored enterprises or agency debt. We're talking about Fannie Mae and Freddie Mac. Are these sources truly available in the Gulf South, given the risk profile we've been talking about?
Oh, they're absolutely available nationwide, and that includes Louisiana. They operate through these really sophisticated systems like Fannie Mae's DUS, that's Delegated Underwriting and Servicing, and Freddie Mac's Optigo program.
What does that DUS program mean in practice?
Well, DUS means the lender, the delegated underwriter, has the authority to issue commitments on Fannie Mae's behalf. It makes the process faster and more certain than, say, a traditional direct lending model. And that's why these platforms are used, especially by professional buyers doing large institutional type deals.
So what kind of properties are they looking for? What's their sweet spot?
They're looking for perfectly stabilized multifamily assets, just boring, predictable cash flow. They typically require high, sustained, stabilized occupancy. We're talking 90% full for a full 90 days off.
Oh, that's specific.
Very specific. They have strict DSCR and LTV requirements that vary by the asset quality and the specific loan product. But really, they want predictable cash flow and clean financials. They tend to favor newer construction or recently renovated assets.
Okay, but the sources we looked at suggest that while agency debt is available, a lot of mid-market Louisiana buyers actually skip it. Or they only use it for refinancing an existing stabilized asset. If it's so fast and standardized, why isn't it the default choice for acquisitions?
Yeah, that's a great question. There are really 5 common and pretty compelling reasons why a mid-market or local buyer often chooses a local or regional bank over a national agency loan.
Okay, what's the first one?
First, the loan size is just too small. A lot of high-quality 5 to 50 unit deals here in the Gulf Coast are below what's considered efficient agency sizing. That usually starts around $2 or $3 million.
Why does that matter?
Because agency loans require these costly mandatory third-party reports, appraisals, environmental assessments, property condition reports, plus significant reserves and specific legal costs. If your loan amount was small, say $1 million, those non-negotiable fixed costs make the agency execution way less competitive than a local bank loan.
Got it. What's number 2?
Second, the property isn't agency clean. This is critical in a market like ours with a lot of older housing stock. Agency loans are extremely rigorous. If the asset needs a lot of deferred maintenance, or if you have an aggressive value-add strategy, which means it's currently unstabilized, or it has ugly collections, or, crucially, it has a challenging insurance story, the agency underwriter will likely just reject it. Or they'll demand reserves so massive they make the whole deal uneconomical.
So if you're buying a property specifically to turn it around, The classic value-add investor agency debt is probably off the table for that initial acquisition loan.
That's exactly right. They want stability, you are buying volatility. Which brings me to number 3, a need for speed and simplicity.
Local banks are faster.
Often, yes. They have fewer third-party requirements and a more streamlined internal committee process. Even though agency debt is delegated, it still involves a pretty protracted due diligence.
Right.
Local banks, because they know the market and they might know you, the borrower, can typically close faster. And in a competitive situation, closing speed is often a major point of leverage.
Okay, number 4.
Prepayment flexibility. This is a huge financial factor people overlook. Agency loans often come with the 5th reason ties right back to the Louisiana twist: insurance and flood friction. If the coverage is complex or expensive or requires those high deductibles, all lenders are going to get conservative. But a local bank that has deep institutional relationships with regional insurers and a localized understanding of specific submarkets, they can sometimes structure around those coverage issues better than a national agency underwriter who's bound by rigid national guidelines.
So, to sum it up, agency debt is probably best for a perfectly stabilized, large, long-term hold. But it's less ideal for that nimble, quick-turn, value-add investor who's really active in the Louisiana market.
That is the most succinct way to put it, yes.
Okay, let's quickly touch on the other major sources. First, what about HUD FHA debt? We hear about that sometimes.
Yeah, this is a deep specialty lane. It's usually focused on things like affordable housing, senior living, or new construction. HUD multifamily programs like the 223-0 for existing properties, they can offer just incredible structural benefits.
Like
very long amortizations, often 35 or even 40 years, and extremely attractive fixed rates because the loans are government insured.
But I'm guessing there's a massive catch.
The drawback is the process. It is heavy. We are talking mountains of paperwork, mandatory environmental studies, property condition assessments, specialized third-party reports, and just significant timing constraints.
So it's slow.
It can take 6 to 9 months to close a HUD loan, which makes it almost impossible for an acquisition unless you have an exceptionally patient seller.
Right. And what about CMBS? We hear that term, commercial mortgage-backed securities, but what is it, and is it a factor here?
So CMBS loans are basically pools of commercial mortgages that get packaged into securities and sold to bond investors. The benefit is often competitive fixed rates and non-recourse terms.
And the downside?
They are extremely rigid. Once that loan is securitized and sold off, the servicing is handled by these large national servicers who have zero local flexibility. They're often used for larger, established properties, but their rigidity and the complexity of their prepayment penalties, usually defeasance again, make them less common for mid-market Louisiana investors who really need flexibility.
So if you're a typical investor in this market, you're almost certainly going to land on either agency debt, if the asset is stabilized and large, or local and regional bank debt for pretty much everything else.
Exactly. Local bank debt is very often the path of least resistance for the regional investor.
Okay, shifting away from the capital sources to the macro environment. If you're an investor, what should you be watching? Should you be watching the 10-year Treasury yield or the Wall Street Journal prime rate to forecast your borrowing costs? Because they move differently, don't they?
They do, and this is a core point of confusion for so many people. The answer is you have to watch the index that matches your loan type. You've got to know your financial foundation.
All right, let's break that down thoroughly. When do we watch the 10-year Treasury?
You focus on the 10-year Treasury yield when you are pursuing fixed-rate long-term debt. So that includes agency debt, CMBS, or those HUD fixed-rate products. The 10-year Treasury yield is it's universally accepted in finance as the benchmark for long-term risk-free borrowing costs.
But what's the rationale? Why would my 20-year fixed loan be linked to a 10-year government bond?
Because a fixed-rate lender is pricing a long-term risk horizon. They determine their cost of funds by looking at the lowest possible risk rate they could get. So their formula is essentially the base rate, which is tied very closely to the 10-year Treasury, plus a credit spread for the risk of lending to you, plus liquidity costs and reserves.
So if the 10-year Treasury yield spikes.
All fixed rates will follow, usually with about a 1-week lag.
Okay, now for the other side of the coin, variable rate bank debt. This would include bridge loans and most local banks' term loans that float, right?
Right. For those products, you watch the WSJ prime rate, or SOFR, which is the Secured Overnight Financing Rate. WSJ Prime is an aggregated benchmark, basically an average of what major banks charge their absolute best corporate customers. So this serves as the base rate. You'll see loan quotes like prime plus 1% or SOFR plus 250 basis points.
And the movement of the prime rate is typically tied to what distinct force?
It tends to move directionally and almost immediately with Federal Reserve policy. Prime is a short-term bank benchmark. If the Fed raises or lowers its target rate, the banks adjust their prime rates to reflect their own cost of borrowing funds overnight.
So the quick decision rule for the listener is pretty simple then.
It is. If your term sheet says fixed and it references treasuries or swaps, you track the 10-year treasury. If it says prime plus spread or SOFR plus spread, you track those short-term indices. Knowing which index is relevant tells you which economic force, long-term bond market demand, or short-term Fed policy is driving your cost of capital.
All right, now we are firmly in the weeds of commercial lending math. These are the two core underwriting terms you have to know cold. They are the fences that limit your loan proceeds. Let's start with LTV, loan to value.
LTV is conceptually very simple. It's just the loan amount divided by the property value. So if a property appraises for $4 million and the lender's term sheet offers a 75% LTV, the maximum proceeds based on value are $3 million. That sets the ceiling.
But there's a crucial reality check for 5+ units that we have to repeat here.
Absolutely. For 5+ units, the lender does not look at value purely as sales comps. The definitive value is anchored by the income approach valuation.
Which is?
It's NOI divided by the market cap rate. And if the underwriter applies a higher cap rate, say 7%, instead of the seller's projected 6% because they perceive more market risk or they've normalized the expenses higher, the appraised value drops significantly. And as a result, the maximum LTV proceeds drop right along with it.
So LTV is really determined by the value that the income supports.
That's the key, always.
Okay, next up. The metric that often governs the deal in high-risk environments like Louisiana, DSCR, the debt service coverage ratio.
DSCR is the measure of the property's safety margin against default. It's calculated as your net operating income, your NOI, divided by your annual debt service, which is your total mortgage payment for the year.
Give us an example.
Okay, so if your conservative underwritten NOI is $300,000 and your total annual debt service is $240,000, your DSCR is $300,000 divided by $240,000, which equals 1.25x.
And what does that 1.25x mean in plain English?
It means the property is generating 25% more cash flow than is strictly required just to pay the mortgage. That 25% is the lender's mandated safety buffer.
A buffer against what?
Against vacancies, unexpected maintenance, economic dips, or, the local killer, sudden expense spikes like a 40% jump in insurance. Lenders require this buffer to ensure their debt is safe. And that required threshold, it varies. Fannie Mae is explicit that DSCR minimums change by asset class. For a very stable asset, you might see 1.30x. But for a value-add or riskier asset, they might demand 1.30x or even 1.35x.
Okay, so we've established the two constraints, LTV, the value constraint, and DSCR, the cash flow constraint. Now, I want you to walk us through the exact step-by-step process of how a 5+ unit loan is actually built and how that final loan size is determined.
This is where so many borrowers make a mistake. They assume the loan size is based on the purchase price, and that is just incorrect. So step 1 is underwritten NOI. The lender starts with the seller's trailing financials, the T12, but they immediately apply massive haircuts. They do not trust the seller's pro forma assumptions. They will normalize expenses. They'll apply an economic vacancy-like, assuming a 5% vacancy rate, even if the property is currently 100% occupied. They adjust for bad debt, and this is key for Louisiana. They apply a normalized expense assumption.
Meaning they use current market quotes for insurance.
Exactly, for insurance, for taxes, and for a proper replacement reserve, not what the seller paid last year. This new conservative NOI is the base for everything.
And these haircuts are designed to create a bulletproof NOI that can survive market turbulence, but it's almost always lower than what the seller was advertising.
It is almost always lower. So once they have that conservative underwritten NOI, they move to sizing the loan. Step 2 is size number 1, the DSCR constraint. They determine the maximum annual debt payment that conservative NOI can safely support. They take the underwritten NOI, they divide it by their required DSCR. Let's use 1.25x as our example. That calculation gives them the maximum annual debt service. Then, using the quoted interest rate and amortization schedule, they solve for the maximum loan amount that corresponds to that payment.
So that's the maximum loan amount based purely on the property's ability to generate cash.
That's the cash flow maximum. Then they determine the second maximum. Step 3 is size number 2, the LTV constraint. They cap the proceeds by the asset's appraised value. the value times the max LTV.
And the final loan amount they offer is?
Step 4. The loan is the lower of the two. It's that simple. And in stable markets, most borrowers expect to be LTV limited. The property's value is the ceiling.
But not here.
But the reality check we constantly see in Louisiana, Mississippi, and Alabama is that many, many deals become DSCR limited after those brutal insurance and flood quotes land. That required 1.25 at DSCR forces the loan proceeds down much lower than the value would otherwise support. And that leaves the borrower with a large equity gap they have to fill.
So understanding whether your deal is DSCR or LTV constrained and why is really the core of smart underwriting.
It's everything. And that intelligence, tracking the nuances of expense creep and those fluctuating insurance costs across South Louisiana, Mississippi, and Alabama, that's precisely why a firm like Bridgewater Realty Advisors excels. They provide their clients with realistic valuations and loan expectations right up front. Because if you don't know your limiting factor, you're just constantly chasing a phantom loan amount.
Okay, so that's how the loan is sized. But let's talk about where deals can quietly drain a borrower's cash. Step 5. Reserves and escrows.
Right. The lender doesn't just hand over the full loan amount. They require several non-negotiable buckets of capital to be held back or escrowed. First, you have the standard ones, your taxes and insurance escrow, where you pay 1/12 of those bills every month.
Okay.
Then you have replacement reserves. These are funds, often $250 to $350 per unit per year, that are set aside to cover the inevitable replacement of big-ticket items like HVAC systems and roofs. This is required even for perfectly stabilized properties.
And what about the specific local requirements we see here?
Well, due to our market conditions, you will often see large market-driven reserves required. Things like named storm reserves or specific cash holdbacks to cover higher deductibles. If the lender's insurer requires a 5% wind deductible and 5% of your property's replacement cost is $200,000, the lender may require you to keep that entire $200,000 liquid or in a restricted account.
And that reserve comes directly out of the borrower's cash needed to close.
Directly. It increases the required equity for the deal, sometimes substantially.
Okay, finally, step 6. Recourse and card-outs.
Yeah, this is important. While large commercial multifamily loans are often advertised as non-recourse, meaning the lender can only pursue the asset if you default, that is a huge oversimplification.
How so?
Every single one of these loans contains what are called bad boy carve-outs. These are for actions like fraud, willful waste of the asset, or gross negligence, and the borrower must be prepared to sign personally for those bad acts. If you commit fraud or you misapply rents, the loan immediately becomes full recourse against all of your personal assets.
So it's non-recourse unless you're a bad boy.
Exactly. Don't be a bad boy.
Okay, we've established that the Louisiana market is acutely risk-sensitive. It's all about that insurance volatility and the DSCR constraint. So our sources provide a standardized stress test that any prudent buyer should run on their pro forma before they even make an offer. Let's present the Louisiana underwriting stress test.
This is your acid test for Stabilio. You absolutely must model this worst-case scenario because these events are highly plausible in this operating environment. The test assumes 3 key events hit the property all at the same time.
Okay, assumption number 1.
Insurance renews plus 40%.
40%, is that realistic?
That is a realistic renewal scenario based on current market trends and the volatility we're seeing in commercial lines. A 40% hike crushes your expense ratio immediately and takes a massive bite out of your NOI.
Ouch. Okay, assumption number 2.
Occupancy dips 5 to 8% for 6 months.
Why?
Because no property runs at 100% forever. You have to assume a slight economic vacancy, either due to normal turnover or maybe after a minor natural event or just a temporary recession. That reduces your effective gross income significantly for half the year.
All right, and assumption number 3.
Taxes and repairs trend up 10%.
Just general inflation.
Exactly. Property taxes are rarely static, and deferred maintenance or just increasing material and labor costs mean that your general operating expenses will inevitably rise. It just pushes the cost of running the business up.
So you run the model, you take your conservative NOI, you jack up insurance by 40%, you drop occupancy by 8%, and you increase repairs by 10%. What is the verdict that the listener needs to look for? What's the pass-fail grade?
The verdict is very simple. If your DSCR collapses below the lender minimum, typically below 1.20x under the simulated stress, you are not buying a stable investment. You are acquiring a refinancing time bomb.
A time
A
bomb.
time bomb. Because if that stress scenario actually materializes, when your 5 or 7-year loan matures, no bank will be able to refinance your loan at the desired size because the DSCR will be too low.
So what happens then?
You're forced to either put in a massive amount of unexpected new equity to pay down the existing principal, or you have to sell the property at a huge loss in a moment of distress. This test just highlights the absolute necessity of conservative underwriting in the Louisiana market.
That is a powerful and an extremely practical framework. This entire deep dive has really been about understanding the localized rules of risk, the hard constraints of commercial math, and the constraints of the capital sources themselves.
That's right.
This has been an incredibly detailed exploration of where the money truly comes from, and maybe more importantly, why it sometimes stops flowing here in the Gulf South region. So let's quickly recap the essential takeaways for our listener.
The 3 points to really remember, the Louisiana twist, are these. First, the local risk stack, which is dominated by insurance volatility and mandatory flood compliance, is the primary driver of all underwriting conservatism.
Number one is risk.
Number 1 is risk. Second, you must always recognize the 5+ unit commercial approach. Remember, the deal qualifies, not you, the borrower.
Got it.
And third, you have to understand the DSCR limitation. High operating expenses in this region often mean the property's cash flow constraint, not the LTV, is what determines your maximum loan proceeds. And you have to run that stress test.
Which brings us to our final thought for today. We spent some time defining the indices that you should be watching. The 10-year Treasury for fixed rates, and the WSJ Prime, or SOFR, for variable rates.
Right. And here is a final provocative thought for you to consider, something that connects your local spreadsheet to the global economy.
Okay.
If variable rates move with the Fed's domestic policy and fixed rates tied directly to the 10-year Treasury, how does the global geopolitical environment, I'm talking about things like wars, massive trade shifts, sovereign debt crises, how does that environment, which heavily influences global demand for U.S. Treasury yields, impact the local cost of capital for a Louisiana multifamily investor today, even if our own Federal Reserve is stable?
So you're saying a crisis in another part of the world could raise my interest rate in Baton Rouge?
Directly. The perceived safety or instability of the entire global economy directly translates into whether a fixed-rate lender prices your New Orleans apartment complex loan at 6% or 7%. It's a powerful reminder that bond traders in London and Tokyo are indirectly influencing the cash flow of your asset, completely independent of local supply and demand or Fed activity.
That is the ultimate global-to-local connection. It's a reminder that no market is an island, and the cost of your capital is determined by far more than just your local market cap rate.
Indeed.
Thank you so much for joining us for this deep dive into multifamily financing and underwriting. We hope you feel significantly more informed and ready to approach your next deal with real confidence. We'll see you next time on The Deep Dive.